For the main event of the evening, Warren Buffett versus me.
Here we start.
We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
Wrong.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
I agree with him on this. If you don't know how to analyze companies, you should diversify. Investing without having a clue can easily lead to disasters. A big problem is that many individuals either massively overestimate their own abilities and thereby harm themselves. This does not necessarily end in ruin, but if you underperform the market for years, then you have certainly not done yourself a favor too. Another phenomenon is that trading and investing is becoming gamified, and that people without fully understanding the products are making very risky bets with a lot of leverage. For example, with options or futures. I don't know if these people are actually looking to build wealth or if they are simply using the stock market as a casino.
If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
I strongly disagree. It is madness to put all your eggs in one basket.
Yeah, I'm gonna go all in because I don't think you got the space.
My goal in investing is to build wealth. But if I risk all my chips at once, I may lose everything, even if I have chosen a great company. This is because, first, everybody makes mistakes. Maybe the company is not so great after all. Secondly, unforeseeable disruptions could happen, a so-called black swan event, and I would be left with nothing. His statements also contradict any scientific evidence. According to present scientific knowledge, the market is efficient, or very close to it. The efficient market hypothesis states that all publicly available information is already priced in. It is therefore not possible to outperform by using chart technique or fundamental analysis. If you find a super wonderful company, you can be sure that many others have already recognized this firm as fantastic too. Correspondingly high is the valuation, and you cannot expect an excess return. The market knows that the company is great and the price consequently is high, and you cannot buy at a discount.
It's a trap.
Scientific studies have also shown again and again that not only amateurs fail to beat the market. Surprisingly, the so-called experts, fund managers, institutional investors, and hedge funds are also no better.
Because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
It's not. Think about the reasons mentioned before. In addition to the things already mentioned, you also will have a significant higher chance of trailing the market if you don't have proper diversification. This is because only a small fraction of stocks are responsible for the majority of the gains. As already explained, it is almost impossible to find undervalued stocks. So you are gambling with no diversification. If you are lucky, one of the big outperformers is in your portfolio and you beat the market. But most of the time, this is not the case, and you have a much worse return than the market yield.
And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own.
It is conventional practice for a good reason. All the people with 9-to-5 jobs don't have the knowledge and time to find potentially undervalued businesses. They are way better off by diversifying and saving time and energy with a buy and hold strategy, meaning that they buy a broadly diversified portfolio of stocks and forget about it. This lazy strategy will outperform most other investors, although you have to invest way less time and effort compared to an active approach. I already made a video about this topic. I will link it. Investment professionals also don't do better than the market on average, meaning that you are not better off giving your money to them. It's also not possible to pick an outperforming manager doing the job for you. This is because past performance is not predicting future results. Accordingly, the outperformance of 99% of the well-doing investment pros is due to luck and not skill.
I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense.
That's a good one. Very misleading statement by him. He only owes Berkshire Hathaway his own company, and it's an investment firm owning many assets. So he at least has some diversification, although only owning one company on paper.
And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas.
Completely true. Great fortunes were not built on diversification. This goes by the nature of things. What he is not telling you, though, it is impossible to identify the next Coca-Cola up front. True, some lucky investors will invest in the next big thing and make a killing. But most investors which hunt the next Coca-Cola will end up being worse off trailing the market. Since the goal of investing is usually capital preservation and saving for retirement, it makes a lot of sense to diversify and not try to get a lottery-like payout. The thing is, if it's public knowledge that a business has a moat around it and that there is not much competition to be expected, this is already reflected in the price and you are not making a bargain buying this company.
There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it.
It's the complete opposite. It could be true that it was possible in the past to generate alpha, excess return above the market rate, as the markets were not as efficient as nowadays. But today it would be suicidal to ditch diversification. If one of your goals is also to preserve your capital. Even Warren Buffett, the presumably greatest investor of all times, wasn't able to generate excess return the last 15 years. But he had great marketing. making you believe he was overachieving. He chose the S&P 500 as his benchmark. This was widely uncritically accepted by most, although a more accurate benchmark would have been a total market index of the US and not just one only covering the biggest companies. With the correct benchmark, he is not an outperformer anymore.
I mean, if you have a really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
It is very obvious that he is speaking from experience only. Bad things can happen to wonderful businesses too. Even Apple, the most valuable company of the world, was on the brink of bankruptcy at some point, before it started to develop great products and became the 2.5 trillion behemoth it is today. It is simply not true that nothing bad ever happens to good companies. They too regularly go bankrupt or disappear into insignificance.
I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And there is no value added.
True, there is no value added if you just buy and hold a diversified portfolio. You will only achieve the market yield minus fees. Nevertheless, this is scientifically proven the best strategy to invest your money. Using this easy, stressless, and almost no time-consuming approach, you will end up outperforming the majority of other market participants. Stock picking, market timing, and a lot of trading will on average lead to you making less profit, because trading involves fees. Picking future Coca-Colas is impossible in practice. The same is true for buying bottoms and selling tops. In addition to that, a lot of back and forth in the portfolio is usually not tax efficient in most countries. Tax systems usually favor the hodlers, as you call buy and hold investors in the crypto market. So being satisfied with the average does not mean anything bad in this context. On the contrary, being satisfied with the average means that you will perform better than most active investors. I say Buffett is speaking from his own experience and not based on scientific facts. He started investing when the markets were not as efficient as they are today, and it was probably still possible to achieve an excess return back then. Nowadays, based on scientific data, this is not possible anymore. Or at least it is insanely difficult. If your investment goal is to save for retirement and not to get a lottery like then, you should definitely diversify. This is because diversification is the only free lunch on the markets, meaning that you can reduce your risk while retaining the same expected return. Risk reflects the bandwidth of fluctuations of your investments. This is also called volatility. It is smaller the more positions you hold in your portfolio, meaning that you can expect steady about average returns instead of wide swings in both directions, which has to be the goal if you really want to save money and build wealth. Let me know what you think. Is my scientifically proven approach better, or is Warren Buffett's investment philosophy the way to go? We end the video with a somewhat out of context quote from Charlie Munger, Warren Buffett's partner, which somewhat mirrors my view of things.
I have great difficulty with it because I am something of a student of dementia, and I have,
We hang around a lot together.
and I can ordinarily classify dementia.
Axel.